Good morning, Flow Show traders. Wishing you all a good week ahead. Hopefully we get a few more eyeballs in as the US clocks have changed, so we might get a few more of those guys popping in. If you are popping in and you don't catch us normally, do feel free to post us any thoughts, views in the comments here on Zoom. Morning, Kay. Had a good weekend, mate?
Good morning, Ryan. Good morning, everybody. Yeah, quiet actually. Quiet weekend. Yeah, went out for a bit of dinner, and then for the rest, no, very quiet actually. Ready for another bumper week now.
Yeah, exactly that. Same over here. Pretty quiet weekend actually. Bit of Mother's Day stuff yesterday. It's Mother's Day here in the UK, so getting the kids to do all their bits and bobs. Good old mum. Right, yeah, big week ahead. We got a lot of stuff coming out of Japan again this week, so we need to get stuck into that. Firstly, we will kick off over in China, where we had CPI finally returning to positive territory. Year-on-year CPI up 0.7%, beating expectations of 0.3% from that prior minus 0.8%, and a 3-month streak broken in negative CPI data there. On the month as well, for February coming in higher than expected, also at 1% versus 0.7 there. But PPI still looking a bit soft, so not out the woods yet. Maybe a bit of a early year bounce we've seen there, but remains to be seen. But they've broke the losing streak at the very least. Over in Japan, we had some data out as well. Final GDP numbers coming in better than expected, so turning around that negative numbers that we saw coming in the early releases there. Machine tool orders, though, still looking down in the dumps, minus 8%, not as bad as the minus 14.1%, but still big negative numbers there. Wages are a big key feature this week. Wednesday, we see Toyota finally getting around to answering wage demands from the unions there. They give their response to that. We also have Kishida holding a 3-way meeting with the government, with Labour and corporate management on Wednesday to supposedly seek to strengthening momentum for higher wages. Part of the big drive for Kishida in all this is to get the wages at small and medium-sized firms going up as well. It's okay hearing the big firms like Toyota and all the other big unions talking about high wages, but it has to be done at the small and medium-sized enterprises, because they employ 70 to 75% of the workforce. So as I say, it's okay Toyota saying, yep, here's a gang-busting 6% wage, but the average is still only expected around 3.9% for the year. In total, and that's only up from 3.85%, wasn't it, Kay, last year? The actual number.
Sorry, 3.85 or 3.58? I don't recall now. I was on 3.58 or so.
Yeah, but the average the people expect this year 3.9%. So that's not as high as we've been hearing from some of the firms. We heard over the weekend that Air Nippon has agreed to hike wages by 11,000 yen, which is the most in 33 years. So that's a big gain. But these are the big companies. It's the smaller ones that need to do the job. So we've got that coming on Wednesday. As I said, the Toyota release of their talks. They're finally addressing talks. They've pushed them back. And then on Friday, and we've looked into this, or some of the guys at Live Squawk looked into this, we have the first Rengo wage talks numbers being released there, how those are going. According to Live Squawk, they came out last time at around 7:45, I think it was, UK time. I'll double check that. Let me have a quick look. Yeah, at 7:45 GMT it came out last year. So that's the sort of time we're looking at on Friday, and that's Friday for that data there. Kay, this wages stuff, it seems like now it's just a question of whether it nails March or April, as opposed to one or other or none.
Yeah, especially that we saw on Friday that report saying that they are planning to change their framework a bit on which could lead to YCC being officially abandoned as well, and they will still buy JGBs, but comparing to what they did before, if the 6 trillion yen are confirmed, of course, because it's still only the press rumors, it would still be a bit less than what they bought over the course of the past years. Well, a lot less over the course of the pandemic, of course, but I haven't compared it to 2019 data. That I did not do. Perhaps I should look back at it. But with everything that comes out, we're opening the door for March a bit more. I'd still. I'm not going to call it a base case anymore because it seems that everything is pointing at a possibility now for March. But I would still say that they may wait for the official rate hike until the start of the new fiscal year. But what they could do is abandon YCC officially and just managing JGB's purchases as the government probably needs them to do. But yeah, and as we've been saying, there's possibly more speculation coming into the Bank of Japan meeting now. That's where we are. The door got it used to be a very small window. Now it's already quite a big door.
Yeah, very much so. And I don't even know if it's just the door frame and no door on it anymore.
Yeah.
Yeah, I think I'm still in the camp. Yeah, March. Overall, I don't think it matters whether they tell us they're going to act. Whether in March they tell us they're going to act in April or whether they act in March, I don't think it matters a whole lot. I still think it's probably likely that March is an announcement of what they're going to do in April, but they could tinker around the edges in readiness for that. Like you say, YCC could potentially widen, and then they say it's going to, with a view to ending it in April or later on. But either way, yeah, we're gonna get something next week. Whether it's an announcement they're actually doing something or an announcement they're going to do something. So I don't think it moves the goalpost too much between what happens in March and April. But this Wednesday and Friday is going to be very important to that. If those wage numbers are up higher than last year, then it's box ticked as far as I'm concerned. But there is still a risk, or the bigger price risk now is if the numbers don't conform and if they don't decide to act, be it March or April. That is the bigger price risk now. Small risk though it may be, we have to keep that in the back of our mind. What will happen if it all goes Pete Tom?
It would be a surprise if we have lower wage hikes now. That would be a real negative. That would be a real negative. Actually, there would be a very big reaction to it. I trust if that would come in, let's say around last year. That's not good. The markets are not going to like it because that's not necessarily that the Bank of Japan is not going to change. We have been saying this for months and months. They are going to change, and the market knows that, obviously. And the market already reacted to it. The market has been reacting to the fact that it may come brought forward, like closer to where we are now. But if they don't get, it would be a real surprise because most of the companies have kind of hinted that they may not go into all those demands of 6% or 5.5% or so. But it should be a little bit higher, and then the judgment case will really also be not only if the Bank of Japan is going to move or not, but the judgment case will be whether the net wage increase is sustainably above what inflation is going to do and the price and the costs are going to do. So that is going to be in a second wave a judgment that the market will have to make. If they are just around CPI or CPI has been coming down, but if the net wages are just above the zero line, that may be another thing where the market says like, well, hang on, that means that the Bank of Japan doesn't have too much room to grow, yeah?
Kate, sorry, mate. Can you
Yeah,
grab? Sorry, leaving the lurch. You just look at prices for a second. I've got to grab this call.
yeah, sure, no problem. Okay, let's go and have a look at what's happening in the markets. So, and since we were talking about the yen, let's have a look on these the short end, right? Because we always look at the 10-year JGBs, which are gradually now ticking up, but also look at because this is shorter to what effectively the Bank of Japan may do, and we've already seen since the start of the year a 20 BPs move. Okay, so assuming that we will have like big wage increases, this one may possibly push up to something like I was looking at it before. If you look at where we were uh, before the whole thing started, before the whole and the quake and everything, we were turning around levels somewhere between 30, 40 to 50 BPs. That is possible. That is possible that the market takes those shorter end rates up to somewhere in this zone here, and that would then reflect what the market is thinking about the expectations for the Bank of Japan. So once we get through this week, once we see those wage talks getting those first results, I think we should look at what's happening, especially on this one here. The 10-year will be more depending on what the whales are going to do with the JGBs. We know that they are waiting for the Bank of Japan to start effectively hiking, but they don't expect that we are going to rally much further than 1%. So we, if they effectively hike, if we go closer to this 1%, this is going already to be a big zone where we are going to have to compare the JGB yields compared to what else is happening in the rate sphere, like the the US yields or the European yields or the sterling yields, because in the end, what's really going to matter for the yen in the longer term is how far is the BOJ going to take it? How good is the economy going to absorb it as well? All right, it should be very good if those yields continue to rise in Japan. It should be very good for the banking sector because especially the regional banks were really complaining about the negative interest rate environment. So that should, and we have seen that already in the Nikkei, even though we see a bit of a setback this morning, apparently. The street is whispering that equity investors are taking a bit of profit right now. But it should here give us a good idea once those yields will come closer to the 1%, what the Japanese investors will do. If they really decide to pile into JGBs again when we go up here, that means that those Japanese yields are going to have a bit of a problem of going much higher, and that in turn may then have the effect again on the yen. But I do think that ahead of the what we are going to see in the wage negotiations, there may be a bit more speculation here, okay, on what's happening in the Japanese yen. I do think that it's possible to have a revisit if we need to stick a price on it around 146, 145.90. I think that's already a decent level that we need to monitor here if ever we come closer to this level, all right? So time and price will be of importance on the yen right now. Time because we are waiting for the results on those wages, and then price because we are getting into retracement levels here. All right, this is just from the start of the year. We are going to see some support popping up 146, 140, 145 and a half. All right, I do think that people speculating okay, but they don't really have the answer yet to whether the wages are going to be high enough for the Bank of Japan to react this month immediately. Obviously, all yield crosses have been coming off. We had a bit of a trend line support here on the euro yen. I've talked about this 161 on the euro yen. It came through, but there again, it's trading lower, but we are starting to stall a bit, and we are, in my opinion, not too far, which lies just below 160 down to 159. Bit of a traffic zone here on the euro yen, and I would pay attention to what happens if ever this week more speculation brings us into that zone. That is one zone that I'm going to keep an eye on, into the BOJ even, okay, into the BOJ.
Hey, mate.
Yeah,
I just wanted to ask one question about the yield situation,
yeah,
because obviously if they start raising rates, yields would start to creep up, and we know that some of the big whales are waiting in the wings to take advantage of that.
yeah.
Could we be in a situation where, I mean, how's it going to work? You know, if they want to get in at yields at 1%, they've got to wait for the yield to go there, because, you know, as we know, price up, yield down. That's how it works. So if people are buying it, it usually sends the yield lower. So people aren't going to be buying it now. In theory, the yields are going up. Just to explain to our viewers. So it's going to be a bit of a waiting game, isn't it, before people come piling in?
Yeah, we have seen apart from what's happening in FX, but we have seen since the turn of the year and since the beginning of the year, we have seen the Japanese investors actually putting money to work, because they're waiting, as you say. They've put their money to work, and they've actually gone to the US and European auctions as well in the meantime. But I think they are well, they are first of all sufficiently patient enough. Those people are not spot FX traders, right? They make decisions every 6 months. And in the past, sometimes even they didn't change anything to their investment programs before the 1 year. But assuming that they are now getting those rate hikes, I'd say watch what's happening between April and so April, June, July. That's the April, May, June. That's the first thing, and then so watch what they decide come June. No, May. Sorry, May, because they usually wait for 2 weeks to 3 weeks into the new fiscal year before outlining their investment plans, and then especially I would say if those yields creep up slowly, especially what their plans are for what we're calling our Q3, which is the start of the second leg of their fiscal year. Usually, we see a shift in their investment behavior. So again, those people are not like in a hurry. They are not spot traders, right? So I think we may even have to wait until September for them to really start to come back and pile into JGBs again. In the meantime, we could have like a bit of a strange kind of effect that they still go to auctions elsewhere, waiting for those yields to go up. But then, and that's what I've been saying as well, there should be a mechanical effect when the Bank of Japan starts to raise rates, or has risen rates a little bit, where they step out of their foreign investments and get back into JGBs. And that's where we could see a big scissor effect. And so this is something that if you're more a medium-term trader, or if you want to make a note for the diaries for that, if we ever get there, then we need to be really careful what they are going to do. And then I'm thinking about the GPIF or the big insurers, or if they decide to bring money back home to get back into JGBs, that should have a pretty big scissor effect in the whole bond market worldwide, especially in the majors.
Yeah, very much. Yeah, it can't be viewed as the same situation as something like the Fed. The Fed took rates up to 5.5% or whatever. Yields went up to that high as well, and the market thought, right, rates are topping out 5%. We're not going to get this level of return on government bonds, so everyone piled in at the top at 5%. And then they can sit on for whatever period, 2, 5, 10, 30 years at those high rates while rates and inflation come down. But it's not the same situation in Japan. When it is, it's going to be much, much smaller margins. Remember, these guys have been getting zero on their bonds, and negative zero for long enough. So even a 1% yield return on something like tens, or like Kay's got there, 1.5%, compared to 0.9 and below 1% for years, is a lot for these guys. So we're not going to be getting the BOJ up to 5% anytime soon. That's for sure.
No, but the thing is as well, that's the difference as well, because what we are looking at are face value yields, right? And you can still argue that the Japanese yields will remain well below the other yields. The problem is with the inflation-linked yields, and the problem was the yield curve so far as well, because they if they put their money to work, they are not getting a very good rate elsewhere either. Because if you look at the hedging costs for the 3 or 6 months, for instance, they are not making too much money, even going into those US 10s at 4.5% or so. So it's a bit of a strange game. So if those yields go up, we can effectively expect them to bring money home. Now, they probably won't do it unless the market takes it straight away because I'm looking at the 20s as well, because they were talking about 20-year as well, the Japanese, because they said, like, when the first time when we came up to 1.5%, they were already quite happy about that. And now we are back in the 20 years above 1.5%. If they get taken up a little more here, I think we are going to see some activity there as well. It's going to be it's going to be a game of really watching what they do, because they are going to influence the market, right? They really will, and that's I've already been talking about that with Blake as well when we had our little trader summit powwow a while back. We have to look at the mechanical effect of what's going to happen. It's not only speculation of the Bank of Japan hiking rates. It's really see what those flows can mean for markets, all right? Because even if they would stay 3-4% below the rest, the first leg should be, and potentially quite big in volume terms.
Yeah, exactly that, mate. Well, thanks for that. Do you want me to go back, or you want to carry on a bit?
No, it's up to you, mate. You know what?
Shall I carry it? Shall I grab it back and we'll just finish off the headlines?
And then, for a while, and then we talk about the rest. I was just, while you're taking it back, going to come back a little on the Chinese data. We've seen we've seen now for weeks, months, the market getting out of China. And now we've had this and the National Communist Party week is over, right? I'm a little cautious on China right now. And I've been saying that in the chat room as well. I'm starting to have the impression that perhaps we are at the low end of we could be at the trough of the market getting out of China. And we must say, if you translate it then to F.A.C.E, we must say that the PBOC has pretty much succeeded in the move higher from year end in all the dollars to cap the dollar China. I'm starting to be a bit cautious here. They may. I'm not saying they succeeded and it's all going to be a long game, right? For the investors to come back into China, but we may be in for at least a period of consolidation, and I would not exclude the China to recover a little bit. That was my thinking when I saw the data, when I saw the reaction in the market today as well. And already last week I've been thinking about that. Would it be possible that China has seen the bottom? And I'm starting to think it's a possibility.
Yeah, maybe, mate. I mean, I'm personally not going to take that 1 month's data as any sign, but yeah, they've got to fix things domestically, and they've got the power to do it. The international stuff, what's going on with everyone else, is a different kettle of fish still. I think we only really see a change mood sentiment internationally
Yeah.
on China when that gets resolved. But domestically, that's one thing, obviously. But there's definitely two games going on in regarding China. They may fix one, the other I think still rumbles on. But yeah,
that is true, Ryan. But I also, wasn't it last week that somebody in Germany, one German official said we can deleverage or something from China, but we can't really get rid of them was not his word, but he says we can't really do without the media. So and perhaps the US is one thing, but perhaps Europe is going to be half a Chinese saver, you know?
Yeah, no, exactly that. And that was most definitely book talking from Germany, because they're probably the biggest country, European country, involved in China.
Yeah,
In terms of trade
and all the big car makers.
Yeah, exactly. But yeah, I mean, for dollar yen, that's a dollar yuan. It's doing nothing. It is consolidating. It's been consolidating since the latter part of last year. So yeah, I don't see any reason for this to change. But yeah, it may just now become a bit more of a rally sell than a dip buy as it was over the last few months. But yeah, I'm not expecting any big fireworks from this. But as you say, we shall see what water passes under the bridge over the months ahead. Right, sorry about that little delay, folks. Important call that I couldn't miss, unfortunately. Right, so let's swing over to the ECB then. June is pretty much signed, sealed, and delivered for rate cuts. It seems, if all the ECB bods are to be believed. We had further sources pieces out that they overwhelmingly favour June for the first rate cut, and then it was said that some policymakers put forward the idea on the sidelines of the meeting about a second cut in July, which was to potentially appease or win over the dovish group who were looking for a potential April start. So there's all sort of horse trading going in there. Lagarde has won her battle not to have leaks coming out on the same day as ECB meetings. They're now coming out the day after. So that's when we got that, because we didn't get our sources piece. ECB's Casimir came out saying that inflation slowdown remains fragile and cutting rates now will be premature. He's another one of the big hawks there. But he said the confidence to cut rates will only come in June after they've seen the data. So June is it. ECB's McClue says that they prefer gradual changes to the monetary policy stance. We've been saying it for long enough, Kay, lining up for the middle of the year. June it is. How many more central banks are going to line up in June?
Likely all of them, apart from Japan, which
and the BOE, I think,
and the BOE, yeah, and perhaps the SMB. But I don't know about the SMB now. They're coming out next week as well, right? So yeah, if they would be tempted to wait, perhaps we need to be a little careful on Swiss positions. But no, yeah, all lining up for June. At least the ECB and the FOMC, and then yeah, and that begs the question: how much can the euro dollar move from now until then? Unless we see like big divergences, of course, on what's happening in inflation. But even there, we have seen a bit sticky all over the place. So tomorrow, US CPI will probably be a mover, and then. But if you look at the global picture, it doesn't tell us that the euro dollar is ready to move a lot. Famous last words, of course. Tomorrow we're trading 107 or 112, but those two are pretty much aligned anyway.
Yeah, but the euro dollar, you would have thought it might have been a bit down on all these rumours about June cuts, like we've had for the Fed when stuff comes out like that. But it just shows you that the Fed is the big game in town, as it was when rates were being hiked. So this is like the same way. But now the ECB is at risk. Again, looking where the balance of risk shifts and the big price moves. The balance of risk shifts now to if the data doesn't conform to all their thoughts about June. If inflation stays sticky, maybe we have another up month or two, and inflation isn't down where they want it to be. nearer to June. Then they're going to have to shift their calls again and maybe push it out to July or whatever. But yeah, so the market is now going to be happy that June is the date. So now what's going to move prices is anything that potentially shifts the meter on that June date rather than confirms it. Right, NFP last week, very strange one. I mean, this tells you something about the market. Okay, you look at these numbers at any other time, and they're all pretty positive numbers. The headline NFP 275 beat expectations, nearly 300,000, all well and good. Last month's big print got revised down quite a chunk, so that was a bit negative. But then there was lots of talk that that number was a bit of a out there last month, but it still came down. It's still in the 200,000, so all good there. The unemployment rate that went up to 3.9%, up 2 pips, so quite a decent move up for unemployment rate. It doesn't usually move in 2 pip clips. That was a negative because the participation rate stayed unchanged. So yeah, that's a negative bit, but it's still at 3.9%. It's still well below, or how you want to describe it, more than full employment. So it's still really numbers we haven't seen for decades. So it's still overall a positive. Jobs data, wages as well, they dipped as expected, 4.3%. Some expectations were for 4.3. This one was 4.4. Prior month was revised down as well. Still hot numbers though, still 4% numbers we're seeing here. So overall, the jobs data was all pretty good, pretty solid. But in the context of what it meant for the Fed, it meant that rate cuts are more of a certainty now when they're going to be, because the unemployment rate ticked up, because the wages numbers came down. So we saw another reaction. Certainly dollar yen didn't need any other invitation to go lower. That came all the way down to 146.50s odd, and before bouncing back again. But as I say, this is still good numbers, still positive numbers. But the market is in a mood where it wants to sell dollars and it wants to get dovish over the Fed again. So that's why we saw the reaction we did over those numbers. Over in Canada, the numbers pretty okay there as well. Employment change was better than expected by almost double. Good looking on the full-time, part-time switcheroo, although it was just a bit of a reverse of what we saw last month. But seeing a lot of those gains coming in full-time, if that trends, then that's potentially strength that we're seeing. Unemployment rate, again, ticking up while the participation rate stayed unchanged. So that was a little bit of a negative. Wages as well, coming down a bit, 4.9%, but still running at hot levels. So moving in the right direction on the inflationary details. Same for the US, but overall still good numbers, but it's how the market interprets those numbers. Fed's Goolsbee said the Fed is focused on the inflation rate, not the price level. Says it's not realistic to expect a price level back to pre-COVID times. Fed's Williams said inflation expectations have come down quite a bit. Demand has cooled amid restrictive monetary policy. Okay, any other bits and bobs that you pulled up?
No, no, not really. On those U.S. employment data, I think people are again. You've got data coming out, but then the people are trying to, or the market is trying to look what's behind the scene under the bonnet,
Yeah.
and still the household employment is going backwards. Still, people are talking about labor costs starting to come down, which is a bit disinflationary. And already, it's not that it reminds me really about the November report, which was a bumper report, but the dollar turned around massively. I don't think it's that, but already since last week we have seen this, and I was talking about that as well. We have seen this big dump in the dollar into year end, then the recovery, and it seems like the market has not decided, but the market is there because you can talk about prices and rates, but it looks to me that the market has said like, okay, this correction is done. Now let's wait and see. So if you got like one little negative in there, like we've seen a lot of comments about like, yeah, but every single month the revision is lower of the prior month as well. People are still taking second, third jobs. That's not the real job market also. But it just looks like the market is now, dare I say, a bit more rebalancing again. We've also seen the yields have not really responded to the face value of the labor report, right? So I think we are now already ahead of what tomorrow's CPI data are going to bring as well. So that's the next likely decision. Little or big one, decision time for the dollar to come, right? So and I think
Yeah.
we're going to jump from one into the other data point now, and we may see different faces just depending on the data now. Right?
Yeah, exactly. And US CPI is the big data that we got tomorrow, as you can see there on the calendar, coming an hour earlier for all us lot in Europe, this side of the pond, because of the clock change over the weekend in the US. All our data comes an hour earlier now. Again, this CPI data, it has a lot of people thinking that there's extraordinary factors in there, the housing, rent, shelters, that sort of stuff that saw that decent number last month. And whether that's proving too sticky and is going to wash out, it wasn't quite reflected across into the PCE numbers. So this one's going to be important. Does it stay higher, or does it indicate and more follow the PCE and cut down, thus cementing the Fed and cutting rates? Also on Tuesday, we got UK labour report. This German CPI is the final number, so not too much to worry about from there. But jobs in the UK, it's going to be worth watching for the pound. We're looking for some green shoots coming after the horrendous Q4 GDP data that might be shown in the monthly numbers for January coming on Wednesday in the morning. We'll see where those green shoots are going to take hold. And that's potentially going to be important as well for the UK election. Sunak has sort of slightly changed his tune since the budget. He was saying that his working assumption was for a second half of 2024 election. He's refused to repeat that or give any other information. Again, this data might be important for those election expectations and when that might drop. But otherwise, a fairly quiet day on Wednesday. Thursday, fairly quiet as well. Not an awful lot, but we got PPI and retail sales from the US. Not a lot in Europe. So PPI retail sales from the US will be important. After that, less than positive retail sales number last month. The market will be seeing if this is going to pick up or whether the consumer is facing a bit more stress than they were previously, which will then be another brick in the wall for the Fed to cut. Friday, we get a few final CPI numbers. Then we get the US Empire State Manufacturing, the start of the manufacturing data for the new month. It's been a bit wishy-washy of late, this Empire, a bit volatile, so we can't really read too much into it, but it might give us a little something on a Friday afternoon. Then we get the flash Michigan numbers coming out, consumer sentiment numbers, which obviously coming after those retail sales, and they've not been great of late either. Also, again, suggest whether the consumer is facing some troubles, shall we say, coming up. So that's our calendar this week. Where am I going now? Let's go back to here. So yeah, yields. This was been the big watch for the last few days because we got back below that 420%. You know, the market getting all cutty over the Fed again, and adjusting rate expectations again. So now we're seeing that coming down again. This is a bit of a wind behind the negative dollar moves we're seeing, the bearish dollar moves we're seeing. So just keep an eye on this. I think if we get under 4%, then things are going to look a bit more bearish for the buck. That'll probably coincide with euro dollar maybe attacking 110. Dollar yen's obviously a bit of it's got the pull and push from both the US side and the Japanese side at the moment. So I'm a bit neutral on what happens here with dollar yen. You know, good news, we could be down at 145. Bad news, we could be back at 150. It really is one of those type of moments where you just got to roll with the punches. It's big data or it's big headlines coming, so the tech you need to be careful of as well. You know, you shouldn't really be looking at this on anything less than a sort of 4 hour chart, anything like that for your levels, because we got volatility up at 9.27% at the moment. So, you know, headlines are going to carve all the way through your short-term tech levels. This is a big thing coming up, a big moment for Japan, and it's not going to give a monkeys about moving averages or fibs at the moment. So just be a bit careful trading yen pairs with this higher vol. Don't rely on the tech too much for that. Stocks are taking a bashing. The Nikkei took a whack overnight. I'm not sure what was behind that, whether it's just this BOJ turn, the market finally jumping on board with that. Maybe something in the data. I did hear something about Kishida's rating, government public rating plummeting over the weekend, but I haven't found any stories of that. So
that's been ongoing for the past months.
Yeah, but this one was a shocker apparently.
No, well, that's what I was saying earlier. There's some whispers in the street that people who bought loads in that Nikkei and the topics have taken a bit of profit. Now the weekend is over and into that big week. It's kind of okay. I mean, kind of logical, I would say, that if you have like very big positions open in the Japanese equity markets and with those events ahead of us in 1 week time, we will have like as well wage negotiation results in a way, and the Bank of Japan. So it's a bit logic that the market takes some chips off the table, right?
Yeah, exactly. And it seems like the move that we saw in Asia here has translated across, as Gavin points out, into other indices as well. Pretty much all the stock markets, you know, looking down at the moment. S&P came off another high. It's making the short-term price action and levels look a bit weak at the moment. You know, we've got a lot of up and down going on here, you know, and trying to find where the levels are. You know, some are washing out, some are holding, showing up 1 minute, not showing up the next. So for now, I think I'm going to get rid of that one. So for now, at the moment, it seems like this 51, 29, 30 level is showing up a bit more now. Support on the way down now. We're just resisting it. Again, we're seeing a bit of action in this zone, 51, 51, 12. We had a little move into it. Now it's holding it. So that, again, is somewhere where I've been looking to see if that develops further, and it might be doing just that. Top side's still a bit messy. We have found resistance again at this 51.50 area. So that needs noting. But that looks like another bit of a blow off the top, as some of you guys in the US like to call it. I know Blake likes to be looking for a bit of a blow off the top. Bit similar to what we got here, but a bit bigger. So yeah, this is now going to be the new marker, which is coming in roughly just short of this 52 big figure. So not real surprised to see some resistance coming in there. But I want to see what happens if we get a retest up here, whether we just continue nicking new highs and moving on, or whether we're going to see something more solid. But for the downside, big level, the real big level is still down here, 50-50, 50-40, 50-40. That's still the massive level. So whatever's going on in here is just discovery mode at the moment for that one. Gold, and everything looks a bit risk-offish today, Kay. You know, this morning, obviously we've had those yen moves on the Japanese use and whatnot, but now we're seeing the Swiss a little bit bid. We're seeing yields down, gold's up, stocks off. It's all this morning's looking a bit risk-offish generally, rather than Japan or US led or whatever.
Yeah, there's a bit of a mix in there, right? And I guess as well, it's ahead of those CPI data as well in the US. You have and then you have decision time, or at least another set of data that could lead to decision time in the yen, and It's a bit of a, yeah, I mean, a mix of everything going on, and the market now likely managing positions and then getting ready for what's to come once more. That's rather what's going on, and we've seen it on the reaction post NFPs as well on Friday, right? You had the dump in the dollar, and then it stopped in euro dollar. We had a bit of a rally in the cable, which stopped as well, and then we're back to a slightly lower levels. Yeah, there's decent levels as well in euro, dollar, in the cable and stuff coming up, because if you, for instance, if you start to get back above those highs in the cable, everybody's going to talk about 130, right? If you start to rally above, where is it in the euro dollar, above
60s,
hmm?
about 160s, 70s, I think the levels up
Yeah,
there.
160, 70, then all of a sudden everybody's saying like, okay, this is 110, and where is it gonna stop then? 110.80 or 110.60. And that's all, it's all in the minds. People are looking at that, and probably flows waiting on the side to take it there as well, if that CPI data is coming in negative. So I think there's a lot of book managing going on right now. And as you say, in the Swiss, maybe the market a bit too short Swiss for the time being. Bit of risk off, bit of liquidation of bit of managing of the books. I say this is just one thing that the market is doing right now, and getting ready for what's to hit the rest of the week. I've got difficulties to read too much in what's really happening right now. I think cable actually is holding pretty well. Yeah, we've been for a bit of a test there of the 85, the figure on euro sterling, which is holding once more. But then the cable is still looking pretty okay. We are above the just above the December highs. And but it's holding just right, which is around 128 and a quarter or so. That's going to be a small level, but as long as we hold above, we will see the combination tomorrow. Tomorrow is going to be an interesting combination for sterling, right? Because we will have parts of that of the job reports in the UK, and then the US CPI, and cable should really be on the move tomorrow.
Yeah, very much so. Okie doke. Unless you got anything else you want to add, Kay, we might call that a session for Monday.
Yep.
Yeah, and but you're right, George. Cryptos, they're on their own different planet as always. I'll let you do the analysis on those ones, mate. Breaking new highs overnight and then down a bit again afterwards. So yeah, there's no stopping them. Right, we should call it a day for today. Hopefully we get you set up for the week well enough, and the events that are coming up. Thank you as always for coming to the Flow Show, and if you're coming for the rest of the week, we look forward to seeing you over the next few days. Thanks a lot, everybody. We'll catch you tomorrow.
Thank you.